Now in the world of trading now, why we can trade in many different ways. One, trade by shares, buy the shares. Two, we can use CFDs, contract for difference. In Singapore context, in Asia context, we use CFDs. CFD is what contract for difference. Basically, you're taking a position with independent third party private market maker for position. So now look over here. Let's say now you got two choice. You want to buy the shares better or you buy option better? Buy shares, 100 shares. Will cost you how much? Then you can see the buying power effect is $6,000. It's 1/4. Okay. This one I think is what basically buying 100 shares of $21,600 worth of it. On the other hand, you buy options. How much should it cost you? Maximum loss? Okay, good. Okay, Thomas, okay, then or if you want to, you can buy a vertical spread. What's the maximum loss?
110.
Huh?
210.
What's the maximum profit?
290.
Solution matter. Depends. But if you are a starter beginner level trader, after that 5K account size is enough already. I learned from Sifu. He showed me the cheapest method one. I could buy one trade for Microsoft that's cheaper than one share. One share is $213.56. Here cost me here it cost me 210 only. Technically, I make it very simplistically. Very little time. They set the rules and regulations and you need to follow. But okay, simple. Worst case, how much you lose? 210. It's not I say one. Okay, you can see 210. Correct. Then this one you buy a straight call to maximize profit because we believe Microsoft can go $260. How much it cost you? $6,000. Thomas, share is safer. I put a $1 stop loss inside. If the market drop $1 against me, I will get out. But in the first place, this is what you call a trade management tool. But what's the risk? What is the risk for this trade? You buy how much first?
21K.
You buy 21K. So your capital exposure is 21K. You buy 100 shares. Yes, the buying power effect is what you call margin given to you. If you go and trade with Kim In, Maybank, or UOB, or Philips Security CFDs, they most probably for Microsoft, they will give you 5 times leverage. So $21,000, instead of $21,000, maybe ask you for $5,000. Some more aggressive brokers in Australia maybe give you 10%. So instead of $21,000, they will give you $2,200. But your risk is still what? No matter what leverage or margin buy power, what is your risk? Your cost of trade is still $21,000. Having a CFD or having a marginal position, just simply the broker just give you the credit. Let's go look at chart pattern now. Stuck. So I hate TD and metric now. This early the day, they are not going to do it. Microsoft, let me go delete everything for you. Let me clear all the nines. I hate all the nines here. Too many nines already. All the years, all these nines I clear. All these are trading positions. In the world of trading, when we do trading time, we are basing on there's a word called stop loss. If the market drop below a certain position when you buy the shares, you come out. So what we can do with Thomas, my stop loss will be a 3 month low here. What's the 3 month low? Means that 1 month, 2 months, get out. This is December, November, October, September. So a 3 month low, what price?
Slightly less than 200.
No, what's the price here? 198. So now, okay, we run out $200 for say argument. So most probably, if you go and base a simplistic stop loss level, You must say a 2 months low is I buy at how much? I buy at $213.36. If the market drops to $200 or drop $200 below, I will close my position. It's what I call a stop loss order. If the order is a standing order, that if the Microsoft drop below $200, it will be triggered and fill whatever market price is. So now question, look carefully. So you buy it at 213, your stop loss order is 200. Good idea, bad idea? You understand saying? Okay, good idea, bad idea. So it's $13. Now let's go back to the chart pattern. It's gonna be fun. Now we got 3 trades here, correct? You buy the share here, you go and buy a $13 stop loss inside. So is it if the market drop below $200, trigger this sell to close order, market order, any price sell for me. You share this is what I call a standing order. Sell to close, stop loss means up. If the underlying I buy for 213, if the market price of Microsoft drop below $200, trigger this standing order to close my order at market price. Means that market price doesn't mean it's triggered at 200 at 200. It's triggered at market price means that whatever market being triggered. If the market price is triggered at 200, market traded at 190, you'll feel at 190. So you know that you are prepared to stop loss. So which one better? Have a stop loss here? So stop loss better? The stop loss costs you $1,300. Buy a straight call costs you $600. For $600, for $1,300, you can buy 2 contracts, please. Thomas, this one 210. Yeah, okay, let's say now your account size is smaller. 210. Thomas, this one no good leh. Make $290 only leh. How to make a living? How make a lot of money? Stop. $290, correct? Ask yourself, what is the return on capital? What's the return on capital?
80.
200. What's the profit?
Profit is 290.
290. What's the maximum loss?
210. 280, right? No. Plus. It's 500.
No, it's wrong. When I say return on maximum loss, return on risk is what? Return on maximum losing risk. How much can I lose? 210. Is it? So my maximum is 290. 290 minus divided by 210. What's the numbers? 160%. 160%. Is it? Around there. Sorry, I don't have my hotkey for my calculator. 290 is about what? 150%? No. Sorry. 130%. So now 130%, correct? So this trade, this cheapo trade of 210 have potential to make 130%. Ask yourself, if you get invested, you go and buy a share for $21,000. For you to make 130%, what must Microsoft share price go to?
1.3.
Huh?
213 times 1.3.
No. It's not. Ask yourself, in order to make 100% return on shares,
100%.
Okay, the thing must go to $426.
Okay.
Correct. Of course, on dollar basis you make more money lah. But then you risk on top basis is more than rest. So if your account size is big, share is good. If account size is sub 20K, then the option is better. Why? Options are at $210 option here. Lose less, make more. Fixed risk, what's up you lose? Drop 0, 210. Hey friend, you can make 130%. There's no way for shares to make 130%. Not within the same time frame of 30, not the same time frame for 32 days. Unless you cannot big sweep first price and total first price together within the same week. Okay, there is a possibility. But what is the probabilities? Probabilities can be calculated. Possibility like you walk the street, kena banged by 2 cars and 1 lorry concurrently. There's still possibility. Okay? So what's that mean? This one I intend to use it as a part of my CFDs versus shares versus options versus spreads. So which one better? For your 5K account size, I think better do something better. Make decent money and still what? Still fulfill the rule. See, when you lose money, it's always based on your capital exposure. No matter how creative you are, no matter how good a stop loss is, your capital is $21,000 capital exposure. Your loss, your risk is going to be $21,000. If you can enter a trade for $210, buy a trade for $210 or $600, no matter how much you lose, you buy something for $600, can you lose more than $600? Yeah, you can if you start creative but you buy something if you follow the rules, don't get too creative, it's safe. So it's what it Thomas, I sell cover call better. Okay, that's a different ball game. Cover call, you buy shares and sell options, you still have a $21,000 risk. No matter how much you do, it's still $21,000 because you buy shares. So option trading now is what where I teach you now. I don't teach you. I trade a lot of shares. Well, my student want me to go and teach him share trading now. He said he want to slowly diverge into scalping using shares because options is not. Sometimes options can, sometimes cannot. But share scalping is very tradable because shares is mother, is 100% pure. It's not derivative. Options is a derivative. So which one better? Buy shares better, buy straight call better, or buy spread better? Depends on your objective. Right. If you're scalping, want to make 50 cents, $1 on Microsoft, then please go and buy shares. Options cannot. Option because of what? Options premium slippage, option premium volatility, the spread change, you cannot do. But shares if you move $1, in favor of you, or $1 against you, you win, lose $100. Can't escape one. But options, you choose wrongly. If you choose the option wrongly or structure the wrong trades, or structure the trade wrongly, or choose the wrong option wrongly, you can be right and still lose money. Shares is shares. If you structure properly, market can go against you, and you still can make some, and you still can make some money. So understand understand why I teach options. I trade shares I can. You saw my slide before, 2 years ago. Go and short 2,000 shares of Facebook at $200. People ask this that is my personal trading. On the other hand, but it's not a problem. But how many of you can handle this risk? It's not I don't want to teach. I can teach you things, but end of the day, my job is empower, and I tell you so you have a better chance of survival.